Hello, and welcome to the UBP Fixed Income Outlook for the second half of 2020. I am Mohammed Kazmi, Portfolio Manager and Macro Strategist, and today I'll be taking you through our outlook and investment views looking ahead. So let's start with where we currently stand in this crisis, where since the end of February, we have come through several important steps, which suggest that much of this crisis is now behind us. We have moved from what was initially a virus shock as COVID-19 spread beyond China and to Europe and the US, to a liquidity shock on the back of stretched positioning and a one-way market, to a capitulation of these positions as investors quickly priced in a global recession. And finally, to the reaction of policymakers, where we see the announcements made by the Fed in particular as having drawn a line in the sand for markets and fixed income especially. If we look at where we are now, we seem to be in the early recovery phase as lockdown restrictions have been lifted and the worst in the data appears to be behind us. Whilst the virus may not have been eliminated yet, crucially we are learning to live with it. And so whilst credit markets initially saw spreads widen sharply to levels last seen during the European sovereign crisis, the normalization in spreads has been quicker than that observed following previous recessions. This has made sense to us, given that this recession is unique and different, especially when compared to 2008. At that time, the rescue tools had to be invented and tested on the go. Banks were lowly capitalized and needed fixing for years following the crisis. This time, however, with the coronavirus, it is one common enemy and one common goal to fight the virus and keep economies running. All the tools from previous crises have been ready and used forcefully and quickly, as the central banks have a better idea of how to react this time round. So although the initial shock has been more brutal on this occasion, the recovery should be much quicker, as we are already seeing. At the height of this crisis, governments put their own economies into what can be described as a self-induced coma, which they are now bringing them out of. Policy support has also been larger now than during the global financial crisis, where importantly, and perhaps unlike previous growth scares, these policies have been pushed from both the monetary and fiscal side. On the monetary policy side, we have seen the Fed go beyond what they did in 2008 by announcing direct corporate bond purchases for the first time, which includes fallen angels, and confirms their bias to keep credit flowing through the system and basically backstopping credit markets. On the fiscal side, the overall fiscal support globally is now around 4% of GDP, so double 2008, and is likely to keep on growing, with the US planning another spending bill. What is really striking here is Europe, where we are seeing two-sided policy support from not only the ECB, who has been the main provider of accommodation in recent years, but also support is set to be coming through the EU Recovery Fund, which is an important step for a synchronized growth recovery in the region. And this growth recovery has already started. Since the restrictions have been lifted, we have seen a clear bounce in the data, whether it be mobility indicators, global PMIs, retail sales. Even with the US payroll data, we are already seeing rehiring taking place, with a number of layoffs being temporary in nature. Therefore, as long as there is no second wave of infection cases that leads to another severe lockdown, it should allow for the recovery to look more of a V-shaped one. And so our base case remains that the impact on growth from the coronavirus should largely be short-lived compared to other recessions. Although there will be some sectors of the economy that take longer to recover, this should somewhat be offset by the accommodation from the policymakers, which we expect to remain intact for years to come after this crisis. So with this macro outlook in mind, I'll now take you through some of our key investment views. With growth having troughed and as we enter the early stages of the recovery, we think that it makes sense to be invested in credit markets, where you can earn the carry, and given that spreads are still well above levels seen pre-virus. We think that one should especially be invested in pockets of the market where there is direct central bank support, such as US investment grade credit. We also think that US IG credit makes sense for European-based investors, given that this direct Fed support, as well as the total expected return being higher than European IG credit, even after taking hedging costs into account. Uncertainty is still present though, with COVID not fully eradicated, and so we think that portfolio construction is still important for absolute return portfolios, where the aim remains to build balanced portfolios of high quality credit and interest rate risk, especially given the lack of inflation, which should keep interest rates capped. This environment still warrants a focus on liquidity, which is why we would recommend for those invested in the riskier segments of the credit market, such as high yield, to do so through CDS indices, where volumes increase in times of stress. And finally, with banks part of the solution to this crisis and not the cause as in 2008, and with the sector in good shape with higher capital ratios, we think that subordinated bank debt through the AT1 market is also an attractive opportunity at this juncture. So overall, we still see opportunities in holding credit as we enter the recovery phase, with spreads offering value compared to levels pre-crisis, and especially when you take into account the significant policy support from both monetary and fiscal authorities. Thanks a lot for tuning in, and for more information, please contact us or visit ubp.com.